Johny. Let's kick off with the big rumour out there at the moment. Standard Chartered looking to take out Old Mutual's stake in Nedbank, that being some 55% of Nedbank, valued at current market valuations on market cap. 40 billion rand would be the number that is being touted about at the moment. Big rally in the financial 15. We saw the sector up as a whole, up 3.5%, and Nedbank certainly rallying almost 5%. Old Mutual gaining almost 6% on the day. Your thoughts on this rumour that appears to be gaining traction, although Nedbank, Old Mutual and Standard Chartered all denying it?
Yeah, the rumours around Nedbank Mutual seem to surface periodically. Mutual's coming out with a trading update tomorrow, first quarter interim management statement, and you often get one of the UK press or South African press touting a bid sort of the day before that, and ultimately one day they're going to be right, but it'll be interesting to see what happens if Old Mutual announces anything tomorrow. I still think it's a bit premature because I think the big hurdle is going to be the South African government and whether they would want to see Nedbank being sold to Standard Chartered.
And certainly, I mean, I would be completely surprised. I've recently interviewed at length both Julian Roberts, the CEO of Old Mutual Group, and Kuseni Dlamini, the CEO of Old Mutual South Africa. Obviously, they're not going to give me any inside information, but certainly the statement there, as it has been for a long, long time, is that Nedbank and that banking operation is core to the Old Mutual South African strategy going forward. Just very quickly, touching on Dimension Data, that stock rallying up 7.5%. We closed at 11 Rand 15 on Dimension Data. Basic earnings per share up 7.7% to 4.2 US cents. And Brett Dawson and his management team just solid as they go. Certainly not disappointing the market at any point.
No, again, the revenues seem to be bolstered obviously by the weaker rand. But I think it was their outlook statement which the market really took a bit of comfort from, because their revenues were down 4% constant currency, and they're still talking about single-digit growth in constant currency revenues for the full year. So they seem to be quite optimistic for the second half, and I think that probably aided the recovery, as did obviously the earnings beat as well.
Naspers, we need to make mention of that stock closing up 3 1/3%, and Tencent, its Chinese asset, out with results, very strong profitability on that front. And again, just reiterating that Tencent makes up about 75 to 80% of Naspers's total net asset value.
Correct. I mean, yeah, very good results again out of Tencent. Our view is though that is priced into Tencent. That stock's trading on a forward P of around 30. So you need to be fairly careful buying Naspers at these levels, because it is very dependent on obviously what happens in Tencent. There does seem to be some offshore investors almost buying Naspers as a cheaper entry into Tencent, buying Naspers as a cheaper entry into Tencent. But yeah, we would be cautious on Naspers at these levels.
And Johny, I'd be remiss if I didn't get your view on what is unfolding in the Eurozone and ultimately what it means for South African equities and other asset classes.
We've been concerned about the euro and the Greece problem for some time. They've obviously thrown a lot of money at the problem, but we don't necessarily think the worst is over just yet. The big concern is obviously how some of the southern European countries are going to repay these extra loans that they've been given. Because ultimately that's obviously the problem here. Greece is just overspent and will now have to tighten its belt, and there's very little measures that the Germans and the others can actually implement to actually get this money back. So we'll see whether it's actually money well spent in the end, and obviously the market's concerned about that, and that's why you've seen, I think, the gold price begin to hit new record levels as well. Gold seems to be trading like a currency at the moment as opposed to just a pure commodity.
Talking about the gold price, do you have any exposure to the yellow metal via an ETF or perhaps gold stocks?
We tend to play the sort of big gold stocks, particularly Goldfields and Anglo Gold. We're constructive on our view on gold. We think gold could definitely go higher. Plus, we think that the gold producers are getting an inferior rating than they should, just given their mix of assets. They seem to be sort of being penalized by their South African exposure. Whereas other sort of North American gold miners have much better ratings. So our view is that there's some upside both in the gold price as well as the rating of the gold stocks, in particular the two big ones, Goldfields and Anglo Gold.
Do you not think that a big hindrance to the South African gold producers is, of course, their cash costs and the dollars per ounce in terms of how much it costs them to get the yellow metal out of the ground? If you look at the international space, we're looking at an average of $450 to $500 an ounce in terms of a cash cost. And in South Africa, it looks as though we're averaging around about, let's say, $700 an ounce.
Yeah, obviously South Africa has deep level mining that does raise our costs. If you do look at a company like Gold Fields, though, a large proportion, 45% of their production is outside of South Africa. Anglo Gold would even be higher. So yes, South Africa specifically, the rand is important, and that obviously puts some pressure on the, as you said, the cash cost. But generally the sort of combined cash costs of Anglo Gold and Gold Fields are not that dissimilar with their North American peers.
Looking at Anglo Gold Ashanti, I think Mark Kutafani would shoot me. His cash cost is actually coming in at $619 an ounce, so much closer to those international cash costs. Johny, where's the market going from here, given the heightened volatility levels? You got to hold onto your hat in this market?
Probably. We've seen the market correct from by about 10% from its April peak to its May bottom. We're now only about 6% off the peak, so we haven't really corrected that much. Our view remains that the markets are expensive both globally and locally. South African market's still on a sort of PE of about 16 to 17 times. And our view continues to be that either we will have a deeper correction or the market will trend sideways for an extended period of time.